We can calculate something similar. Let's say it's called receivables turnover. By the way, pay attention to the fact that when I do the inventory, I use cost of goods sold because inventory is recorded at the book value, at the cost. That's why I compare it to cost of goods sold instead of sales. On the other hand, accounts receivables are after sales, so I compare it to sales. Let's do this for NVIDIA. The total sales is for the 12 month that ended in January, end of January, six, slightly higher than 60 billion. Nine two two. And receivables, they're obviously in the balance sheet. 9999. So it's slightly over six. That means NVIDIA turns its inventory over about 6 times a year. Similarly, we can calculate something called day sales and receivables, aka average collection periods. The reason I haven't calculated this for Walmart and Kroger, they're in retail business. Most of their receivables are receivables from banks as a result of credit card and debit card transactions. So they tend to be 4 or 5 days, which is not very interesting. But on the other hand, this ACP is equal to, again, using annual sales number, 365 divided by receivables turnover. So it takes NVIDIA about 2 months to collect receivables. Remember, most of NVIDIA's customers are other companies, so they extend them trade credit. So on average, NVIDIA's customers pay them back in about 2 months. Again, you want this number to be low. Why? Those, if it's receivable, that means you produce something and you spend money on it, you're going to fund it. We will also look at something called payables turnover. Technically speaking, this is a liability turnover. This is cost of goods sold divided by accounts payable. So let's look at for NVIDIA. Let's get the accounts payable first since I'm on the balance sheet. They are right about here, 2699. And cost of goods sold, which is cost of revenue, 16621. which is similar to the receivables turnover or days sales in payables, 365 times payables turnover. Remember, NVIDIA also has to pay their suppliers. That means whatever raw materials and other stuff they have from their suppliers, uh, they on average they pay them over 60 days. More than likely, NVIDIA outsources their actual chip production to Taiwan Semiconductor Company. They give them the specs, those guys produce it, ship it, and it takes NVIDIA about 2 months to pay them back. If you're doing working capital management, that's actually ideal. It takes you 2 months to collect your receivables, but you also pay your own suppliers in about 2 months as well. So you don't need any extra financing to run your business in a sense. You're financing your receivables with payables. Companies whose average collection period is much higher than their payable period, they're spending extra money to fund it. Certain companies, their average collection period is actually low and payable, day sales and payables is pretty high. The biggest example of that is Dell. Most of Dell's receivables are basically they have to wait for the credit card companies to give them the money, but they tend to pay their suppliers around 90 days. So they use their own suppliers to fund their operations. Download Dell's 10K and, you can calculate that number. Again, we want days sales and payables high, but days sales in receivables, which is the average collection period, low. So if I'm evaluating the working capital manager of the company, which basically manages the short-term finances of the company, I'm going to evaluate them based on these two. Well, the mother of all asset efficiency ratios is total asset turnover. We're going to abbreviate that to TAT, which is sales over total assets. The way to interpret that is how many dollar of assets do I need, or how many dollar of sales I generate using $1 of assets. We obviously want that number high. Whatever assets I have, I want to be able to make that a pretty high number.